of January revealed a number of things, and as the staff suggested for additional consideration, these two topics plus two others, that we look out for the investing public when brokerage apps, when robo-advisors are using new data analytics and marketing to us using behavioral prompts to possibly get us to trade in a way that benefits them, benefits the application and the program, in conflict potentially with what benefits us, the investing public. Also embedded in some of those issues are the structure of the stock market itself. It's so much of the market now is evidenced in the report in January in these months. About half of the market is not going to the transparent sort of market, that fully lit market that you earlier showed, but it's going to dark pools and wholesalers. So those issues the staff suggested up. We're going to take a closer look in terms of what policies can help the public.
Chairman Gensler, it's great to have you on the show again. I know that your position on trying to invest well. I read a great book that you wrote about no free lunch. That's why we have diversification. And then I read this report, and I absolutely understand. It's very thorough. It's got great stuff and talks about how options didn't really affect things and what did impact. And then on page, the last notes, number 2, there's this sentence. Payment for order flow and the incentives it creates may cause broker-dealers to find novel ways to increase customer trading, including through the use of digital engagement practices. I read this, and it felt like a bit of a lamentation. I felt that right before that you talked about, don't forget, companies underneath the memes are actual employees, customers, plans to invest. And then you get to this, and I wanted you to be able to say, maybe this is unfortunate. Because I know that people want to open and have as much engineering, financial, but this is not Chairman Gensler. Chairman Gensler is against any idea that we should be doing these digital engagement practices that might hurt investors.
So let me sort of address that. I think that we've found throughout our economy, on platform after platform, whether it's in streaming apps, retail apps, various social media, that we're in a transformative time. The 2020s is rapidly changing. On top of the invention of the internet many decades ago, we have data analytics, artificial intelligence that markets to each of us a little differently. I mean, you might type something in a text and then all of a sudden find you're being advertised something you typed to a personal friend in the text. So those features are all around. What we're raising the question is in finance, what does that mean for finance? These digital engagement practices, the underlying separating you from me and from all of us, and then if the application's marketing for their revenues. And payment for order flow does have an inherent conflict that the brokerage application is increasing their revenues if we trade more. And so are they using these behavioral prompts to get us to trade more or to move to different products, options trading or trading on margin, which inherently have more risk in them? And where do we, the SEC, help the investing public out to help them do well when there's these inherent conflicts inside the kind of inside the box?
Right, but I guess what I struggle with is you've got this great moment here. There are 1 million of these accounts belong to investors with an average age of 19. I think these investors, if they're focusing on, let's say, trying to put together a fantasy team, I think they're spending a lot more time on fantasy, trying to figure out who's on waivers tonight, how to be able to make it. So what's the line? What's the over? They're spending more time, Chairman Gensler, on their fantasy lineup than they are trading. They're trading like banshees. Don't we want to encourage them to spend as much time as they do in their fantasy lineup?
Well, I think that investing for the long term tends to have higher returns than day trading or even hourly trading. And sometimes, not always, but sometimes these applications encourage individuals to have high trading volumes or trade on margin or options that have inherently higher risks. And so that's where there's a worthwhile public debate. And I thank the staff of the SEC to serve up this report. I think, yes, as you said earlier, now it's the job of the commission to sort through what we do with these additional considerations.
Mr. Chairman, the staff determined that a short selling squeeze was a factor, but it wasn't the primary reason for the big sell-up price run-up in GameStop. It was positive sentiment, I'm reading from the report here, that sustained the weeks-long price appreciation. Positive sentiment, not the short squeeze. Short covering was a small fraction of the overall buying volume. I guess I'm wondering, though, despite that, you've been talking about potential changes in short selling rules. Do we need to make any changes? Do we need more, for example, disclosure about short selling?
I think that the markets could benefit from greater transparency, not only on short selling, but a related activity in the markets, which is called stock loan. When you borrow a stock to sell it short, our U.S. Congress actually about 11 years ago passed two provisions that directed the SEC to do greater transparency in short selling and this related activity, stock loan. So I have asked staff for recommendations on this to promote, meaning that on a regular basis, the market would benefit from seeing the volumes and activity in the lending market, meaning lending securities, and also this short selling activity.
Just to follow up on payment for order flow, I mean, most viewers of the trading activity in the last 30, 40 years agree that the American investor has never gotten a better deal. Not only have commissions essentially go to zero, but even trading costs are much lower. Execution quality has improved dramatically in the last 30 years. I know there's a little bit of debate about exactly how much, but the average investor seems to be getting a very good deal. Do you feel you're going to be actually able to demonstrate a real harm from payment for order flow, number one? And number two, could you tell us what comes next here? You've got the commission with your staff with a very excellent report on the facts, but not a lot of direction about where it should be going. Is the commission then going to meet and make recommendations or make rule changes from here? What's the path here forward after this commission staff report?
Well, let me say this. You're right that our markets have gotten more have moved to zero commission, but it doesn't mean it's free. There's still payment underneath these applications. It also doesn't mean that it's always best execution. And we've had cases where we've announced in the last 18 months where there has been this conflict between the broker on the one hand and this payment for order flow on the other. And let me just remind your viewer that if you place a retail market order, as shown in this report, the vast majority of those don't go to the transparent lit markets. They go to the dark market, these pools that are not competing. And so I've asked staff, can we achieve this simple concept that your order, when you place it, competes with other orders? And buyers, if you're selling, will compete to get and to pay you, hopefully, the best execution for that price, order by order by order. That's what I've asked staff. And I think that that's an important concept of competition that helps the investors on one side, helps the companies on the other side that are raising money in our markets.
Well, Mr. Chairman, again, I want to praise the staff because those who read this will know there was not a vast conspiracy against them, which was really the topic that I know a lot of us felt we were really razzed by because we were all in on some sort of Citadel conspiracy. I think that's completely busted this. But there was something on page 12 that disturbed me. You talk about some in the marketplace may possess superior information about underlying assets. That, sir, I think is illegal. Did we discover that some had superior information and therefore should be in front of the commission to find out what the heck went on?
Well, I think that you chose the words carefully, maybe there, but when order flow, when trading is being purchased and sent to one wholesaler or another wholesaler, then they have information that the rest of the market may not have, at least for a short period of time. And even milliseconds matter in these markets. And so that's what we're also looking at. You're absolutely right that I think from a policy perspective, want to look at that and how we instill greater competition, in essence, for that data as well as for that order flow.
Chair Gensler, David Faber here. We had you on not that long ago, obviously a long-ranging interview. I wanted to come back to SPACs, if I might, just for a moment. Haven't really heard that much from the SEC yet, and I wonder where you are, because it does appear that the market has been making its voice heard when it comes to SPACs. We are seeing the sponsors changing their compensation arrangements. We've seen the PIPE market really freeze up. And so is the market doing its job, and the SEC therefore perhaps doesn't have to take significant action in any way in terms of regulation for SPACs?
I think that there is a need here for greater transparency, greater disclosure. These are innovations that have happened in our market, special purpose acquisition companies, but they're costly, and they may also have inherent conflicts between a promoter or sponsors taking generally about 20% of the offering. That if you raise $1 billion, that's $200 million. Can I repeat the number? $200 million to basically raise money in a blank check type of shell company. And then you have 2 years to go out and try to buy something. And there's also this conflict that if you don't buy something, you don't get, the promoter, the sponsor doesn't get that 20%. So there's an incentive to buy something even if it's not the best purchase in the world, particularly as the clock is ticking and you get to the end of the 2 years. So I know I've said this a lot about staff working on recommendations. These rules are highly detailed. We need to work on the economic analysis, which is so critical to good decision making. There are 5 commissioners. And so the process does take a number of months. And sometimes the public says, oh, where's that document or where's that rule proposal? But I would envision that staff will put something up to our 5-member commission. And if there's the support of the commission, we'll put it out to public comment with regard to SPACs, with regard to a number of these other topics we've talked about as well.
Just a follow-up to my question, the second part you didn't quite answer. What's next here? What happens after this report? Does the commission meet, your 5 commissioners, discuss what you want to do? Are you going to propose rule changes? I know you have a request for comment on digital engagement practices that are out there. What will become of that? I guess I'm looking for a roadmap for what you're trying to accomplish here.
So the 5 of us generally meet bilaterally, and then sometimes we meet as a group. And as a group, when we do that, often that leads to what's called a public meeting, and the cameras are on and the like. In terms of what's next is staff recommendations on the plumbing. This is called the clearing and settling side. There seems to be broad support in market participants to shorten the settlement cycle. We are secondly assessing the comments that came in on digital engagement. I've asked staff to consider whether there's some recommendations we'd have on those potential conflicts and also better protecting the public. And then the third area that was highlighted was market structure, the entire equity market structure. We haven't updated it in 16 years, since 2005. And I think technology has changed so dramatically that it's worthwhile taking a very close look and seeing if we propose something out. In all of these areas, as well as short selling, which I talked about earlier, that I would anticipate we'd propose things because Congress has told us, mandated that we need to. In these 4 areas, I'd envision as staff is debating it, commissioners will weigh in, and then if we think so, we'll put it out to public comment. My hope is that we put it out and have a lively public debate and see what's best for the markets and for the investing public.
Mr. Chairman, on page 6, in order for a customer to trade options, broker-dealers must conduct due diligence that option trading is appropriate for the individual customer. Sir, Robinhood has millions of customers. There's no way they're doing that. I mean, isn't it time we examine that process?
Well, so this is one of the challenges that to get greater access, our user interfaces on our mobile phones have made it very efficient. But then the question that you've just raised is also appropriate. Is somebody on the other side looking as to whether doing the due diligence, as you say, about that customer opening a higher risk account, an options trading account, for instance, or a margin trading account? And I think the staff appropriately flagged this issue.
Mr. Chairman, I want to thank you for coming on and giving us your thoughts, and we very much appreciate the work of your staff in laying out the facts. And obviously, this is a very important historical document in terms of what happened, and we look forward to having you on again soon to let us know what the next steps are. Gary Gensler, Chairman of the SEC, thank you very much for joining us.
Thank you.
Bob, appreciate that.
Thank you, Carl.
Yeah, that's great, Bob.